I need you to pay very close attention to what I'm about to show you, because what's happening in the metals market right now is something most people won't see until it's too late. And by then, the opportunity will be gone. 3 days ago, something changed. Not in the headlines, not on CNBC, but in the actual mechanics of how gold and silver trade. And if you understand what I'm about to explain, you'll see why the next 72 hours could determine whether you're positioned correctly or left watching from the sidelines. Let me start with a number that should make your ears perk up: 412 tons. That's how much gold central banks bought in just the first quarter of this year. Not the whole year, the first 3 months. To put that in perspective, that's more than they bought in any full year before 2022. We're talking about the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, all moving in the same direction at the same time. But here's what's really interesting. They're not announcing these purchases anymore. China went silent on their gold buying for months, then suddenly revealed they'd been accumulating the entire time. Why the secrecy? Why the coordinated silence? Because when you're preparing for something big, you don't advertise it. You accumulate quietly before the crowd figures out what's happening. Now, let me show you what's happening in the COMEX warehouses, because this is where things get really fascinating. Registered gold, that's the gold available for delivery, has dropped to levels we haven't seen since 2016. We're talking about roughly 8.5 million ounces of registered gold backing a paper market that trades hundreds of millions of ounces. Think about that ratio for a second. It's like a bank that has $10 in the vault but has written checks for $1,000. It works fine until people start asking for their money. And they're starting to ask. In the last 6 weeks, we've seen delivery requests spike by 340%, 34%, 340%. Somebody out there is converting paper contracts into physical metal, and they're doing it fast. When you see that kind of movement, it tells you one thing: the smart money doesn't trust the paper anymore. They want the real thing in their possession. Let me tell you a story that illustrates exactly what's happening right now. In 1971, France did something that changed everything. Charles de Gaulle looked at the Bretton Woods system, looked at all the dollars America was printing to fund the Vietnam War, and said, "I want my gold." He sent a warship to New York Harbor and demanded the United States convert France's dollars into physical gold at the agreed rate of $35 an ounce. Other countries started doing the same thing. Germany wanted their gold. Switzerland wanted their gold. And suddenly, Richard Nixon had a problem. There wasn't enough gold to back all those dollars. So on August 15th, 1971, he did something unprecedented. He closed the gold window. He said, "We're not converting dollars to gold anymore." The dollar is now backed by nothing but faith. Gold was $35 an ounce when Nixon made that announcement. 9 years later, it hit $850. That's a 2,300% increase. Not because gold became more valuable, because the dollar became less trustworthy. Now, I want you to think about what's happening today. We've got $34 trillion in national debt. We're adding $1 trillion to that every 100 days. The Federal Reserve's balance sheet exploded from $4 trillion to $9 trillion in just a few years. And countries around the world are watching this happen in real time. So what are they doing? They're pulling a France. They're converting their paper into metal, but they're doing it quietly, methodically, without making a big announcement that would spook the markets. China isn't sending warships. They're just buying every ounce they can find, month after month, without telling anyone until after the fact. Here's where it gets even more interesting. Look at what's happening with silver. The gold to silver ratio just hit 84 to 1. That means it takes 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio has been closer to 60 to 1. In Roman times, it was 12 to 1. Right now, silver is historically cheap compared to gold. But here's the kicker. Silver isn't just a monetary metal anymore. It's an industrial metal that's absolutely critical for the technology we're building. Every solar panel uses silver. Every electric vehicle uses silver. 5G infrastructure, medical devices, water purification, all of it requires silver. We're using more silver than we're mining, and we have been for years. The above-ground stockpiles are disappearing. The Silver Institute just released data showing that industrial demand for silver hit a record high last year, and it's projected to go even higher this year. Meanwhile, mine production is flat. We're not finding new silver deposits fast enough to keep up with demand. And unlike gold, which mostly just sits in vaults, silver gets consumed. It gets used up in manufacturing processes where it's not economically viable to recover it. So you've got shrinking supply, exploding demand, and a price that's still 50% below its all-time high from 2011. Does that make sense to you? It shouldn't, because it doesn't make sense. The only reason silver is this cheap is because the paper market is suppressing the price through massive short positions. But that can only last so long. Let me tell you what happened in 2008, because there are some eerie parallels to what we're seeing now. In the summer of 2008, everything looked fine on the surface. The stock market was still near all-time highs. The financial media was talking about a Goldilocks economy. But underneath, in the plumbing of the financial system, things were breaking. There was a guy named John Paulson who saw it coming. He looked at the mortgage-backed securities market and realized the whole thing was built on garbage loans that would never be repaid. So he bought credit default swaps, essentially betting that these securities would collapse. Everyone thought he was crazy, until September 2008 when Lehman Brothers failed and the entire system nearly came down. Paulson made $4 billion, not because he was lucky, because he saw what was coming before everyone else did. Right now there are people making similar bets in the metals market. They're looking at the same data I'm showing you, the central bank buying, the warehouse drawdowns, the delivery requests, and they're positioning themselves for what comes next. The question is, are you going to wait until CNBC tells you about it, or are you going to pay attention to what the smart money is doing right now? Here's something most people don't understand about gold and silver. They're not investments in the traditional sense. They're insurance. They're the asset you hold when you don't trust the system. And right now, the system is showing some serious cracks. Look at what happened with Silicon Valley Bank. Look at what happened with Credit Suisse. These weren't small regional banks. These were major financial institutions that collapsed almost overnight. The government had to step in with emergency measures to prevent a full-blown panic. They had to guarantee deposits above the FDIC limit. They had to create new lending facilities. They had to do whatever it took to keep confidence in the system. But here's the thing about confidence. Once it's lost, it's very hard to get back. And every time the government has to intervene with emergency measures, it erodes confidence a little bit more. People start asking questions. If these banks were so safe, why did they need to be rescued? If the system is so stable, why does it keep breaking? And when people start asking those questions, they start looking for alternatives. They start thinking about assets that exist outside the banking system. Assets that can't be created out of thin air by a central bank. Assets that have held value for thousands of years. Now, I want to address something important here because if you're sitting on a significant amount of retirement savings, this next part is crucial. A lot of people have their wealth tied up in 401ks and IRAs, invested in stocks and bonds, completely exposed to the financial system. And they think that's safe, because that's what they've been told. But what if it's not? What if the next crisis is bigger than 2008? What if the government can't just print their way out of it this time without destroying the currency? Quick aside here, if you've got $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. It's worth looking at if you want to diversify out of paper assets while keeping the tax advantages. Just something to consider. Anyway, back to what's happening in the market right now, because the timeline on this is compressing fast. The COMEX has a problem. They've got a paper market that's roughly 100 times larger than the physical metal backing it. That works fine in normal times, when most people are happy to trade paper contracts back and forth. But when people start demanding physical delivery, the whole structure becomes unstable. And that's exactly what we're seeing. Open interest in gold futures is near all-time highs, but registered inventory is near all-time lows. That's a squeeze waiting to happen. It's like a game of musical chairs where there are 100 people and only 10 chairs. Eventually, the music stops. When that happens, when the paper market can no longer deliver physical metal to everyone who wants it, one of two things will occur. Either the price will spike dramatically to ration the available supply, or the exchange will change the rules to prevent delivery. They've done it before. In 1980, when the Hunt brothers were trying to corner the silver market, the COMEX literally changed the rules mid-game to prevent them from taking delivery. But here's the difference. The Hunt brothers were speculators trying to manipulate the market. What's happening now is central banks and sovereign wealth funds securing their reserves. You can't just change the rules on the People's Bank of China. You can't tell them they can't have their gold. That's a geopolitical crisis, not a market regulation issue. So the pressure keeps building. Every month, more gold leaves the warehouses. Every month, more countries announce they're diversifying away from dollar reserves. Every month, the gap between paper and physical gets wider. Let me give you another historical example because this pattern has played out before. In the late 1970s, inflation was running rampant. The government kept telling people it was under control, that it was transitory, that it would come down on its own. Sound familiar? But people who were paying attention saw what was really happening. They saw that the money supply was exploding. They saw that real interest rates were negative. They saw that the government was spending far more than it was taking in. And they moved their wealth into hard assets. Gold went from $200 an ounce in 1978 to $850 in 1980. Silver went from $5 to $50. People who positioned themselves early made fortunes. People who waited until the media was talking about it paid top dollar and bought near the peak. The key is recognizing the pattern before it becomes obvious to everyone. And right now, we're in that early phase where the smart money is positioning, but the mainstream hasn't caught on yet. Look at what's happening with the BRICS nations: Brazil, Russia, India, China, South Africa. They're working on creating an alternative to the dollar-based financial system. They're talking about a gold-backed trade currency. They're building payment systems that bypass SWIFT. They're signing bilateral trade agreements in their own currencies instead of dollars. This isn't conspiracy theory stuff. This is official policy being discussed at the highest levels of government. China and Russia are already settling some trade in yuan and rubles. India is buying Russian oil in rupees. Saudi Arabia is discussing selling oil to China in yuan instead of dollars. Every one of these agreements chips away at dollar dominance. And when dollar dominance fades, when the world doesn't need to hold as many dollars in reserve, what happens to all those dollars? They come home. They flood back into the U.S. economy. And that's when you get real inflation, the kind that destroys purchasing power and wipes out savings. That's why central banks are buying gold. They're preparing for a world where the dollar isn't the undisputed reserve currency anymore. They're diversifying their reserves before everyone else figures out they need to do the same thing. Now, let's talk about silver specifically, because I think silver might actually be the bigger opportunity here. Gold gets all the attention. Gold is what central banks buy. Gold is what makes headlines. But silver is where the real supply-demand imbalance exists. We're mining about 830 million ounces of silver per year globally. We're using about 1.1 billion ounces per year. That deficit is being made up by above-ground stockpiles. But those stockpiles are finite. At some point, probably sooner than most people think, we're going to run into a situation where there simply isn't enough silver to meet demand. And unlike gold, you can't just substitute something else. You can't make a solar panel without silver. You can't make certain medical devices without silver. The industrial demand is inelastic. Companies will pay whatever they have to pay to get the silver they need. Right now, silver is trading around $31 an ounce. In 2011, it briefly touched $50. In 1980, it hit $50 in inflation-adjusted terms. That's over $150 in today's dollars. I'm not saying it's going to $150, but I am saying that at $31, with the supply-demand fundamentals we're seeing, silver is dramatically undervalued. The gold-to-silver ratio at 84-1 is telling you the same thing. Historically, when that ratio gets this stretched, it snaps back. Silver outperforms gold, sometimes dramatically. In 2010 to 2011, silver went up 400%, while gold went up 70%. The ratio compressed from 80-1 down to 32-1 in just 18 months. Could we see that again? Absolutely, especially if we get any kind of supply disruption. Mexico and Peru produce about 40% of the world's silver. If there's political instability, labor strikes, or environmental regulations that shut down mines, that supply comes off the market immediately. And with inventories already tight, that would send prices soaring. Here's what I want you to understand. The metals market is not like the stock market. It's not driven by earnings reports and analyst upgrades. It's driven by supply and demand, by monetary policy, by geopolitical shifts that take years to play out. But when those shifts reach a tipping point, things move fast. We saw it in 1971. We saw it in 1980. We saw it in 2008 to 2011. And we're seeing the early signs of it again right now. The central bank buying, the warehouse drawdowns, the delivery requests, the BRICS currency discussions, all of it is pointing in the same direction. The question is not whether gold and silver are going higher. The question is whether you're going to position yourself before the move or after. Because once this becomes obvious, once the mainstream media is talking about it, once your neighbor is asking you about buying gold, the easy money will already be made. I'm not telling you to bet the farm on this. I'm not telling you to sell everything and go all in on metals. What I'm telling you is to pay attention to what the smart money is doing. Central banks are buying gold at record pace. Sovereign wealth funds are taking physical delivery. Billionaire investors are allocating significant portions of their portfolios to precious metals. These are not stupid people. They have access to information and analysis that most of us will never see, and they're all moving in the same direction. That should tell you something. The window of opportunity here is narrow, not because the metals are going to crash, but because the price is going to move, and once it does, you'll be buying at much higher levels. Right now, you can still get gold under $2,700 and silver under $32. 6 months from now, those might look like incredible bargains. Think about what happened in 2020. Gold was trading around $1,500 in March. By August, it was over $2,000. Silver was at $12 in March. By August, it was at $29. People who bought in March doubled their money in 5 months. People who waited until the media was talking about it paid peak prices. The same pattern is setting up again. The fundamentals are even stronger now than they were then. The debt is higher. The money printing is more extreme. The geopolitical tensions are worse, and the physical market is tighter than it's ever been. I want to leave you with one final thought. In every major financial crisis, there are people who see it coming and people who don't. The people who see it coming protect themselves. They move their wealth into assets that will hold value when everything else is falling apart. The people who don't see it coming lose everything. In 2008, people who owned gold and silver watched their purchasing power increase while everyone else watched their 401ks get cut in half. In the 1970s, people who owned metals preserved their wealth while inflation destroyed everyone else's savings. In 1971, people who understood what Nixon's decision meant positioned themselves for the biggest gold bull market in history. Right now, we're at one of those inflection points. The signs are all there if you know where to look. The central banks know it. The sovereign wealth funds know it. The billionaires know it. The question is, do you know it? And more importantly, are you going to do something about it? The next 72 hours matter because momentum is building. Every day, more gold leaves the warehouses. Every day, more countries announce they're diversifying reserves. Every day, the supply-demand imbalance gets worse. At some point, probably soon, this is going to reach a critical mass where the price simply has to move higher to ration the available supply. You can wait and see what happens. You can hope that everything works out fine and the system holds together. Or you can look at the evidence, look at what the smart money is doing, and make a decision to protect yourself before it's too late. The choice is yours. But the clock is ticking, and in this market, time is not on your side.